Buffett, Burry, Klarman, Ackman. These names don't just represent wealth, they represent foresight. While most people are distracted by headlines and stock tips, the smartest investors are making quiet, strategic moves. Recently, 13F Filings revealed something unusual: shifts in portfolios that could signal what's really coming. And no one's talking about it. What do they see that the average investor doesn't? Why are they piling into certain assets and fleeing others? This isn't about fear. It's about preparation. In this video, we're diving into the latest smart money moves and what they tell us about the economy, the markets, and your financial future.
What are 13F filings?
Most people have never heard of a 13F filing, yet it's one of the most powerful tools available to any retail investor. Every quarter, institutional investors managing over $100 million in assets are legally required to file a report with the SEC, listing their holdings. This includes legendary names like Warren Buffett, Michael Burry, and major hedge funds. Think of it as a window into what the smartest investors in the world are actually doing with their money, not what they say on TV, not what the media speculates, but what they're really buying and selling. These filings are usually released about 45 days after the quarter ends, so yes, there's a delay, but patterns still emerge. You get to see conviction. You get to see trends. You get to see which sectors the smart money is rotating into, or out of. This isn't about following blindly. It's not a crystal ball. But it's the closest thing we have to a scoreboard. Because talk is cheap. 13F filings are real moves, backed by billions of dollars. And if you know how to read between the lines, they can reveal what's really happening beneath the surface of the market.
Buffett's caution move.
Warren Buffett isn't known for panic. He's known for patience. For discipline. For waiting years before making a move. So when the Oracle of Omaha starts quietly piling up over $350 billion in cash, it's not a random act. It's a signal. His latest 13F shows something unusual. Berkshire Hathaway is reducing its exposure to major financial stocks, including trimming its position in Bank of America, one of its core holdings. At the same time, he's not aggressively buying into new sectors. Instead, he's sitting still and stacking dry powder. This isn't the behavior of someone chasing opportunities. This is the behavior of someone preparing for impact. When Buffett does nothing, it speaks volumes. Because for him to not invest, even with billions on hand, means he sees something coming that most people don't. A correction. A credit crunch. Maybe even a systemic breakdown. And here's the truth. Buffett never times the market. But he prepares for it. So when he retreats like this, the question isn't is something wrong? The question is, what does he know that we don't?
Leelu's portfolio cut.
Leelu isn't a household name. But he's the investor that Charlie Munger once called the Chinese Warren Buffett. And when someone with that kind of discipline starts making bold portfolio moves, it's worth paying close attention. In his latest 13F, Leelu made 2 major cuts, and they weren't small. He slashed his position in Bank of America, and more surprisingly, trimmed his stake in Alphabet, Google. Let that sink in. Google is considered a wide moat stock, dominant in search, advertising, and cloud infrastructure. It's the kind of company that most investors dream of holding forever. But Leelu is stepping back. Why? This isn't panic selling. It's portfolio rebalancing, and it sends a clear message: caution. Especially in sectors that are highly sensitive to interest rates, regulation, and AI disruption. Even the strongest tech companies aren't immune to systemic pressure. And if investors like Leelu are lightening their exposure, it tells us one thing: smart money is preparing for a different future. They're not dumping everything. But they're tightening the sails before the storm. Are we doing the same?
Klarman doubles down.
While some investors are trimming tech, Seth Klarman is doing the opposite. In the same period when Leelu was reducing exposure, Klarman's Baupost Group increased its position in Alphabet. And significantly so. Why the contrast? Klarman isn't driven by short-term headlines or hype cycles. He's a deep value investor. He sees Google, even after its explosive decade of growth, as a business with strong fundamentals, predictable cash flow, and reasonable valuation in a market flooded with overpriced hype. To him, this isn't about reacting to fear. It's about doubling down on companies that still make sense long-term, especially when volatility makes them cheaper. This is where the lesson comes in. Not all smart money moves the same way. Leelu is playing defense. Klarman is playing offense. Both are smart. Both are disciplined. But each has a different style, strategy, and risk tolerance. So the question isn't who's right? It's what kind of investor are you?
Bill Ackman's big bet on Uber.
While Buffett holds cash and Klarman leans into stability, Bill Ackman is making a bold move, and he's going all in on something unexpected: Uber. In just one quarter, Uber became the largest position in Ackman's portfolio. That's not a gradual build-up, it's a full-on, high-conviction bet. Why? Because Uber is no longer the money-losing experiment it once was. It's now profitable, cash-generating, and operating at scale globally. Ackman sees something most people still don't: a turnaround story that's already in motion, but still undervalued. He's betting on behavioral lag, that the market hasn't caught up to the company's new fundamentals. And if he's right, he's not just buying a ride-sharing app. He's buying into a platform with massive future potential in delivery, logistics, and autonomous systems. But here's the real takeaway. Smart money doesn't just chase what's safe. It also finds value where others still see risk, and acts early. Uber might not seem like a Buffett stock, but that's exactly the point. Ackman isn't Buffett. He's playing a different game, and playing to win. So ask yourself, do you only invest where it feels safe, or where the upside is still misunderstood?
Michael Burry's full pivot.
If you think the market still makes sense, Michael Burry would like a word. The man who predicted the 2008 crash has once again flipped his entire portfolio. He's not just reducing risk, he's hitting the brakes hard. In the latest filings, Burry sold nearly all of his stock positions. And in a dramatic pivot, he opened put options, effectively shorting many of the same stocks he once owned. Why? Because to him, the risk isn't just financial, it's geopolitical. He's moving away from tech growth. Away from China exposure. Away from anything that could be vulnerable in a fragile global order. Burry's bets showed deep concern over international instability, fractured supply chains, and potential conflict escalation. This isn't just a market call, it's a worldview shift. While others talk about soft landings, Burry prepares for impact. His actions remind us, sometimes, preservation matters more than growth. And in times like these, protecting capital isn't fear, it's strategy. So what's the message? When one of the most contrarian minds on Wall Street clears the deck. It's not noise. It's a signal. Are you listening?
Closing insight.
So what did we just see? Not every move from smart money looks the same. Some are loading cash, some are betting big, some are walking away entirely. But here's the one thing they all have in common: they're not standing still. And that matters. Because in times of uncertainty, doing nothing is still a choice, and often, it's the wrong one. You don't need to copy them. But you must pay attention. Because behind every trade, there's a signal. A shift in strategy. A quiet read on risk that's worth noticing, especially when these are investors with decades of skin in the game. These aren't people who panic. They prepare. They don't follow headlines, they read patterns beneath them. So let me ask you, which move surprised you the most? Was it Buffett hoarding cash? Burry going full defensive? Ackman betting it all on Uber? And more importantly, what are you doing about it? Because you're not just an observer in this market. You're a participant. And in the months ahead, those who sit still may find the ground shifting beneath their feet. But those who prepare, even quietly, will have an edge the rest won't see coming. So if you had to follow one name into the next storm, would it be Buffett, Klarman, Ackman, or Burry? Let's talk about it in the comments. And if you're serious about building a portfolio that can weather the chaos, protect your downside, and still grow in the long run, don't just watch. Take action. Like this video, subscribe, and check out the next one, where we show you exactly how to craft a crash-resistant portfolio. Because smart money's already moving. The question is, are you?